wealth or those housing prices as the source of this consumption and the collateral for all of our borrowing from abroad. This is the problem. Now, of course, when interest rates start to fall, when prices start to fall, people think, well, the Fed will just cut interest rates and save the day with some rate cuts. It's not going to happen. Once the bubble bursts, cutting interest rates doesn't stop it. Greenspan brought interest rates all the way down to 1%. It didn't stop the NASDAQ decline. It happened anyway. Once money starts moving out of an asset, it moves out of that asset. Low interest rates aren't going to do anything. And the bigger problem, though, is the dollar. Right now, as I said, the dollar, I think, is poised for a substantial decline. Once the dollar really starts to fall, interest rates are going to have to rise and rise sharply to shore it up because we have no savings. We've got to pay the Europeans and the Asians to hold their savings in our currency. And when our currency starts to fall, the only thing that we can do to entice them to hold it is to pay them higher and higher rates of interest. And in 1980, when Ronald Reagan came in and we tried to stop the decline of the dollar, which lost 2/3 of its value during the 1970s, we did it, but we did it by putting short-term interest rates up to 20%. Now, imagine what would happen in the U.S. economy if interest rates were even half of 20%. What would the interest on the national debt be? Oh, $1 trillion a year. Where the hell is the government going to get that money? Imagine if people's home mortgages were now based on an overnight Fed funds rate of 10%. Could anybody make their payments? Where would this economy be? What would happen to Fannie Mae and Freddie Mac? Would they still be around? You know, those tranches that we're shorting, according to the statistics, all it takes is about 5% of 5% loss rate on these collateralized mortgage obligations. Just 5 cents on the dollar is lost, and it wipes out that tranche completely to zero. I think about a similar amount of losses would wipe out Fannie Mae and Freddie Mac, and of course the government has an implied guarantee of all that debt. And of course, Barry talked about inflation and how inflations have destroyed countries. It's not inflation that destroys countries, it's governments, because governments create inflation. Governments create inflation by creating money. And that's the situation that we're staring at, because as the housing bubble implodes, as the economy implodes, as these entities go bankrupt, like the Pension Guarantee Corp, like Fannie Mae and Freddie Mac, the incentive to monetize that and for the politicians to print enough money to try to make good these promises is tremendous. It's the same type of incentives that the Argentines faced, that the Germans faced in the Weimar Republic. That's what led to the inflation. And that's something that potentially we're staring at. I hope it doesn't get to that worst-case scenario, but unfortunately, that type of inflation is the only thing that's going to stop nominal real estate prices from collapsing. If we don't have that, if the government does the right thing, we will see real estate prices decline dramatically. Not only will all the gains of the last 6 or 7 years be completely erased, but prices will be lower than they were in 2000. Lower by a considerable margin. And as I said, if it doesn't happen, if we have inflation, it really doesn't matter if you live in a $1 million condo, if you have $10,000 worth of groceries in your refrigerator. Relative prices don't matter, right? And that's what might happen if we just have enough inflation so that nominal housing prices don't collapse, but real housing prices have to go down. And that's real housing prices relative to the price of everything else. Am I out of time? Anyway, thanks.
All right, you heard it from the bear. Let's bring back the bull. Oh, maybe not quite that type of bull. What we're going to do for you now, folks, is give you an opportunity to ask these two gentlemen some questions. The rules of engagement will be that you can go to one of the two microphones out here in the center. Please make your question straight and to the point. We don't want to hear any long stories. Unfortunately, we don't have a long period of time. So straight to the point questions, direct them to one or the other of our guests, and then the other guest will have a rebuttal. And the rebuttals will be, the answers and rebuttals are limited to 3 minutes. First question, Paul Donahue.
Thank you. Peter, comment and question. You seem to be ignoring the fundamentals of population growth, supply and demand that could help ease the implosion, but in light of that, with your belief system, where are the opportunities in the next year or two as you see it for
Well, first of all,
capitalizing?
I think the demographic argument is a ruse. it's very similar to the arguments that were perpetuated by the analysts during the 1990s to explain the valuation model. The eyeballs and click-throughs, they were always trying to, they didn't want to admit it was a bubble, so they tried to rationalize it. The demographic argument is flawed. I mean, the demographics are no different than they were in the 1980s and the 1990s. I mean, there isn't a bigger influx of population. In fact, I remember having an argument with someone in California who was talking to me about the demographic argument. Then I had to show him that California was actually losing population, that he was actually wrong in what was happening with the demographics. This has been a credit bubble, pure and simple. It has nothing to do with the fundamentals. If the fundamentals were in charge, prices never would have risen to these levels. You know? And so I am focusing on the fundamentals. That's what I'm doing. That's what I did in the 1990s with the stock market. I wasn't distracted by all the propaganda by the Wall Street community about why to justify this mania. Just like I'm not being distracted now by David Lair or all the propaganda coming out of the real estate industry about why this is justified. It's not justified. It's a pure and simple mania. You want to look at manias, look at, been manias all throughout history. Again, we had one on the internet, but we had, you go back to tulip bulbs or you can Mississippi bubble or all kinds of things and railroads in the 1900s. It's a mania, and it's always the same type of stuff. As far as where are the opportunities, there's a lot of opportunities now. If in the real estate market, the opportunities are probably to stay away from it and maybe buy some things when they get very cheap. Don't buy too early because they're going to get a lot cheaper than you think. In the meantime, you want to keep your wealth out of the U.S. dollar. As I said, the dollar is going to lose a lot of value. If it lost 2/3 of its value during the 1970s, it can probably lose 3/4 or 90% of its value in the next 10 years, which means foreign assets will go up 5 to 10 times. So if you have your assets, if you have your wealth in euros, in yuan, in Australian dollars, if you own other assets, then you'll have a lot more purchasing power to buy very depressed U.S. real estate in several years.
All right. Dr. Asmus.
The Brookings Institute did a big home study just recently, and here is what they said. A study funded by the Brookings Institution Metropolitan Policy Program indicates that by the year 2030, about half the buildings in which Americans live, work, and shop will have been built after the year 2000. The nation had about 300 billion square feet of built space in 2000, but by 2030 we'll need 430 billion square feet of space to accommodate growth. While 82 billion of that will be in the form of replacement of existing space, 131 billion will be new space. Once again, to review that, half of the buildings that we will be occupying in the year 2030 have not been built yet. It must occur to someone that there's great opportunity yet in building some more. Recently, Harvard, I don't quote them very often, but their big housing report, the most immediate, this is from that report, the most immediate risk to the housing market now comes from the rise in interest rates, the erosion of affordability after years of strong house appreciation, and the growing inventory of both new and existing homes for sale. But unless the broader economy stumbles and job losses mount, and of course that's what Peter's worried about too, home sales and construction activity will likely dip only modestly. Over the longer term, the outlook for the housing market is favorable. With household growth accelerating and second home demand climbing, the number of conventional homes completed and manufactured homes placed in the coming decade should easily exceed the 18 million added between 1995 and 2004. As a result, housing production should average more than 2 million units annually over the next 10 years. And just one more quote, and this is from someone in your industry. His name is Douglas Duncan, chief economist at the Mortgage Bankers Association. He observes that 34% of American homeowners have no mortgage debt, and 48% have fixed-rate mortgages. That leaves 18% with adjustable rate mortgages, of which 6 percentage points are probably subprime. He doesn't see how these numbers add up